Let's take a look at the U.S. markets as we have started this new trading day. And right now we are seeing the Dow higher by about 0.4%, but there is some cautiousness on getting into that beaten up technology sector. Alan Nuckman joining us, Chief Market Strategist at Bullseye Option. Alan, nice to see you. What's the daily conversation you're having these days when it comes to the markets?
Well, it's all about commodities, as you well know. Now, last week could be termed as kind of a blow-off top. It happened in crude oil where we made new highs. Now we're 20% off those highs. And the same kind of thing happened in gold. Gold actually ended up being positive on the week, but it's more than $100 and some off its top. And lastly, if you want to look at commodities, wheat was down $1 last week. So again, a lot of new highs and some lower closes. That's negative technically, but I like how the stock market has stabilized, and we've had more than 2 weeks since that last extreme low, and we haven't tested it or rejected it so far.
Well, it's kind of interesting. There's this common dialogue where people are reluctant to own growth stocks because we're in a new environment, and there was a lot that's not reliable today. Maybe tomorrow, maybe they grow into those earnings, but there's some froth in those stocks that's hard to justify in this market. There is a certain irony, though, in the commodity world. We had a good conversation with a veteran energy trader earlier in the program about how there is a sizable chunk of the oil trade which is purely based on the geopolitical headlines. Yes, it's hard to take out the supply-demand component of that. It is a key component, but then there also is some hype trading perhaps within that price, which when the negative headlines come in or when the headlines change, I guess that's no surprise to see all of a sudden oil moving in the other direction. It's moving in the other direction today.
Right, and there's a lot to that. So there's a lot of hype and hysteria. That's just how oil trades. It's one of the most volatile that exists. But let's dial down here. From 2011 to 2014, oil was around $100 a barrel, okay? The stock market moved up 50% during that time frame. So $100 a barrel is not catastrophic for the markets. And if you adjust the price for inflation, crude oil would have to get to $195 a barrel to take out that 2008 high. So we're still a long ways away. And that price action last week was kind of a blow-off top, in my opinion. Let's see what happens here. But some of these energy stocks need a break, need a little bit of a breather. But at the same time, I still think there's tons of value. The risk reward, like you talked about, for some of those stocks, some of those technology stocks that have just been battered, I think are set up as a trader. I like a lot of the opportunities that we're seeing. You can't forget it's this simple game: buy low and sell higher. That's all this is. And so I think over time, we've seen the S&P consolidate here, and it's got a nice wedge pattern. If we can break out to the upside of this wedge that we've seen with higher lows and lower highs, then you could kind of shake this up a little bit, because the sentiment has gotten so negative. I think the number I saw from somebody was the 10-year lows in sentiment, in consumer sentiment. And we know, unfortunately, the masses are usually wrong.
I just want to put what you're saying in context with the makeup of the Canadian market versus the U.S. market, stock market, I mean. Right. We say it a lot, but I'll reiterate it for some of our audience, that for the TSX, you've got about 30% of the overall weighting of the index in energy and materials. In other words, largely energy and gold stocks. And it's been a big year for those names. For the S&P 500, I'm looking right now in real time, and at best, we're at 6-7% of the index being directly tied to materials and energy. So it just screams of the differences. And I said it earlier, I mean, last week was a hard week once again for Canadian tech stocks, but you wouldn't know it if you looked at the headline number for the benchmark, because once again it was higher. So as somebody who's also trying to see where the rhythms of the market go for the rest of the year, and you talked about commodities at the offset, are you feeling like commodity-rich markets like the TSX are poised to continue to outperform the S&P, or does that weakness we've seen in some of those growth stocks start to change the storyline as we go through the year?
For me, it's all about risk reward. And some of those gold stocks, some of those energy stocks had such a move that I use that, I sell into strength. So I took some profits in Bloomberg. I took some profits in these other stocks that have had big run-ups, even though the markets, let's just say in America, the S&P has been down. So for me, it's about money management. So right now, I look to see value in some of the big name, innovation stocks, that's not going to change. Everybody says they were pricey back, in the last decade. So I still think, as a trader, that I like to be buying those closer to their lows, see how they respond. I use options, so I'm buying July options at minimum, so I got 4 months of time for things to settle out. But what I saw in the S&P was really important. 2 weeks ago, when it made that extreme low and that extreme turnaround, that's the capitulation you want to see. Now, we haven't built on it yet, but what we did see was new lows, but not new highs in volatility, meaning that the shorts didn't have the strength that they had before. That's usually the sign of a bottom, and you're seeing that in so many stocks right now. Now, there's still a lot to be done, but, again, corporations in America are doing very, very well, and their margins are increasing. They're having pricing power now. They're able to raise prices. The reality is that prices have reflated, and I keep using that word every time I'm on, have reflated back to where they were. If you use 2020 as your baseline, yes, inflation's had a big jump because that's what you're comparing to, the catastrophic. That's just math, okay? But in the big picture, we've gotten back to a more normalization of prices, and we didn't have any inflation for the longest time, so now it's overshot on the upside. Now, I think part of this would be when the Fed raises rates, which is going to happen here this week, finally, I think we could see a little bit of a relief rally because we've been talking about this for months and months and years, and now it's finally in the pipeline, and it's going to top out at 2%. Short-term rates here in America are going to top out at 2%. That's nothing. That's still ridiculously cheap.
It's something we'll be watching very closely as we move towards Wednesday, and we appreciate your view.